Good morning. The topic of discussion is insurance and its principles. Insurance. Insurance include all types of insurance, whether life insurance, general insurance, or in general insurance, there are so many types of insurance like fire insurance, marine insurance, mediclaim, auto insurance, bike, automobile insurance. Okay, all insurances come under crop insurance under insurance. Okay, so first of all you have to discuss what is insurance. Insurance is a cooperative method. It is a cooperative method of distributing losses falling on individual or his family over a large number of persons, each bearing a nominal expenditure. That nominal expenditure is basically the premium of the policy, right? And feel secured against heavy losses. This is a simple definition, but I will clarify this thing. Insurance is a contract between two parties. One is insurer and one is insured. Insured always pay some amount of premium to the company, to the insurance company, and insurance company, you can say, give guarantee to that person. If loss occurred, then they will pay the amount to the total loss to the party, aggrieved party. But in case of life insurance, this is short payment which is made to the party either at the end of the policy or at the maturity of the policy or at the death of the person. This is a cooperative effort, means so many people pay premium to the company, and each and every person pay premium annually, quarterly, half yearly, monthly, or monthly to the company. And company means insurance company, and insurance company gave them amount or claim at the time of heavy losses, except life insurance. Suppose 100 people pay premium, but loss occurred with one person, then all the 100 people's cooperative effort help one single person. So this is a this particular insurance term is associated or based on the principle of cooperation. So here come the principles of insurance, a very important topic from examination point of view. Principle of insurance. First principle is principle of cooperation. Cooperation. Cooperation means if one person is providing for his own loss, it cannot be, strictly an insurance, because in insurance the loss is shared by so many people, group of people, large number of people. Huh? Uh, People willing to pay to the company, and company will pay you, compensate you in case of loss, as I had discussed earlier. Principle of cooperation we will explain with the help of one example. Say, in a particular organization there are 100 employees. Each and every employee has one car. Okay, each car worth rupees 5 lakh. Average cost is 5 lakh rupees. If suppose one car lost by theft, under these circumstances, the amount of premium which is paid by each and every employee to the insurance company in the form of premium annually, say around 6,000 per year, that particular amount is used to pay the amount to that employee whose car was stolen, right? This act is purely based on the principle of cooperation. So cooperation is a very important factor here. It was agreed between individual and society. They pay amount to the company, and company will pay you, money, but on the basis of the contribution of each and every party. Then we have, even in the principle of cooperation, one more point that is very important I have to discuss here, that is theory of probability. Theory of probability or theory of game, both applied on insurance. When we toss a coin, when we go play a dice, okay, at that time there may be a chance of getting one head or tail in case of coin. In case of dice, either we will have one or two, three, four, five, six. Similarly, there are six chances because there are six number on different sides. Similarly, in case of insurance, everything occurring of the event can be calculated by dividing the total number of occurring of the event to the probability of occurring of the special event. Means probability means what? Probability means probability of occurring of the special event divided by probability of occurring of all the event, right? So, for example, if I have a coin, I toss the coin, I get head. In that case, happening of the special event is 1 and happening of all the event is 2. So my answer is 1 by 2. So probability, the concept of probability is very much applied to the insurance also. Premium is the price of insurance sought for. Insurance company must quote this price to the insured before entering into contract. That amount which is quoted by the company should be able to estimate its cost to itself. The cost basically depend upon death or happening of the event. Okay, happening of the event is basically the probability. There may be a chance of loss, there may not be the chance of loss, because even in case of life insurance, why I'm discussing here in probability section life insurance, because all people not died before the maturity of the policy. Few people, 1% or 2% have a probability after second year or third year of continuing the policy, the person become dead. In that case, this is the loss for the insurance company. Otherwise, at the time of maturity of the policy, you already paid the premium to the company and company will pay you the sum assured and bonuses, etc. Similarly with all other insurances. Then we have next point, that is principle of large number. The principle of large number is, this is the second principle. Principle of large number is applied while calculating the probability. This is basically, this is the general basis presented by Bernoulli's theorem. Bernoulli's theorem, everybody I think well aware that theorem was given in the theory of probability. Large number, which may be explained in two ways. We can say that if we discuss in extensive numbers of trial or observation, okay, greater is the probability that the event under examination will occur in numbers proportionate to their respective chances in a single trial. Okay, and the second thing is the number of trial or observation may be determined to so large an extent as to make the probability of the event happening in number within any specified limit. Or we can say in a simple language, the large the number of exposed person, the better or the more practical would be the finding of the probability. So large number is applied in the principle of probability, because if you increase the number of samples or number of trials, so you have better chances to get the correct answer. Without premium, no cooperation is possible, and premium cannot be calculated without the help of probability. As a result, no insurance is possible. So, principle of large number is equally important, right? If large number of people contributed their insurance, their premium, in that case, loss is, if suppose loss occurred, that loss will be shared by so many people in the group. Then next point is principle of insurable interest. What do you mean by insurable interest? A person is interested in uh, we have one example. A person is interested in marine adventure, where he stands in any legal adventure or to any insurable property at the risk, or we can say in a very simple language, a contract of insurance does not undertake to check the occurrence of the risk insured against. It promised to make good the financial loss caused by operation of insured risk. Say, when a motor vehicle is insured against accidental damage under the motor insurance policy, the policy does not provide a guarantee that an accident will not happen, but the policy promises you to indemnify your financial loss if loss occur. Hmm? What is the insurable interest in this? The vehicle belongs to you only. The vehicle belongs to you. In that case, company will pay you in case of loss. Principle of insurable interest again applies to property also. If you are very much interested in property insurance, in that case you must have some monetary interest in that particular property. So there are certain essential elements of insurable interest. uh, there must be a property or right or interest in the product you wish to insure. Such property, right, life means the subject matter. If you want the policy of your son is very much related with you. That's why you have an insurable interest in your son. You not go for the insurance of your neighborhood uh, person, right? Because you don't have any insurable interest in the property, right? So, and very important thing, time factor is very important in case of insurable interest. When insurable interest must present depend upon the type of insurance. In marine insurance, it is required only at the time of loss, not at the time of issue of the policy. Insurable interest at the time of the loss, right? In case of vehicle insurance, your insurable interest must be at the time of taking the policy and at the time of loss, in both the cases, at both the time period, right? Suppose I have a policy. At the time of policy, I am the owner, I was the owner of my car, but after 3 months or 4 months sold out that particular car to someone else. In that case, if loss occurred to that party, so loss will there is no insurable interest of mine. I'm not able to get money out of it, because earlier insurable interest was belongs to me. Now insurable interest shifted to someone else, because property converted into shifted to someone else. Then we have principle of at most good faith. In case of any insurance, the legal there is one term we use, that is kivit emptor. Kivit emptor means buyer beware. Buyer beware principle applicable. It means that at the time of entering into contract, it is the duty of the buyer, it is the duty of the insured to satisfy himself or herself of the subject matter is genuine and the age of the person is genuine. But this principle does not apply to insurance contract. Insurance contract, however, are the contract of at most good faith. This fundamental rule applies to every type of insurance, right? You have to disclose the plus and minus point related with the subject matter, whether subject matter is human being, whether the subject matter is your hospital, property, your car, your shipment or your voyage, anything, right? You have to disclose each and everything. If you are taking the mediclaim policy, you have to disclose your sickness, types of diseases. Otherwise, If later on, if something will recovered, in that case, company will not pay you anything, right? You have to disclose this fact to the insurance company. In case of fire insurance, there is an installation of fire extinguisher appliances in your company, and you also tell them the fact that which could be we have proper arrangement to met with the losses. Or in case of plastic industry, you tell them there may be a risk of fire, so that the company decide premium accordingly. Then we have principle of indemnity. What is principle of indemnity? Indemnity means a company will pay you only in case of loss. You have to pay the premium. First year you pay the premium, loss not occurred, company will not pay you even a single amount and policy over. In the very next year again you have to pay the premium. If loss occurred, company will pay you. If loss not occurred, company will not pay you, right? In case of fire insurance, in case of marine insurance, in case of motor insurance, in case of crop insurance, if loss occurred, then and only then company will indemnify you. They provide you compensation, they provide you claim, right? Then we have the next, but this principle of indemnity is not applicable in case of life insurance. Then we have principle of subrogation. What is subrogation? Subrogation may be defined as the transfer of right and remedies of the insured to the insurer who has indemnified the insured in respect of loss. Suppose insurance company had compensated you for the entire loss. In that case, whatever is left with you regarding your property, on that property, on that subject matter, now the right is very much with the insurer, right? Insurance company, because already pay you, in that case they have a right to sell whatever is left and recover some amount. The application of this principle of subrogations are: the subrogation right do not arise under ex gratia payment, right? The right of subrogation is limited to the contract of indemnity only. Means subrogation applies only to the extent of indemnification. The insurer cannot recover more than what he has paid to the insured. Suppose they pay to the insured only 1 lakh rupees, so they subrogate from the property only up to 1 lakh rupees. If something more recovered from the property, then suppose they recover 1 lakh 10,000, they have to return to the party, because they already indemnify only 1 lakh rupees to the party, na? So they have to recover, if possible, they recover the loss from the property up to 1 lakh rupees. The rest amount is they have to hand over to the insured person, right? And duty of insured to help insurer. Always it is the duty of the insured person. They help the insurer for regarding the recovery and recovery of loss from the third party, not only from the property but from the third party also. They have a right through legal action or through legal activities, they can recover the amount. Then we have principle of proximate cause or cause proxima. This is principle of proximate cause or cause proxima. It means the maximum is said cause proxima, non-remote cause. Means if you are insured against some risk, if loss occurred against that risk only, then and only then insurance company will compensate you. Otherwise, insurance company will not compensate you. For example, an insured suffered some accidental injury and was taken to hospital. um, during the treatment he contracted an infection, and that infection disease, you can say, which caused his death. In that case, the court gave a contrary statement because the proximate cause of death was a disease, not the cause of accident. Okay, because you are insured against accident or something, because in case of motor insurance, if due to accident, if death occurred, then and only then company will pay you. But here, because of infection, death happened, that's why company will not pay the person. Or we have another example: due to fire, if suppose wall of the building was left in a dangerous state, if suppose municipal corporation or municipal authorities, for the sake of the public safety, ordered it to be demolished. Okay, and during the demolishing process, if suppose the wall fell on the adjoining building and damaged it, the owner of this building claimed the loss under his fire policy. Court uh, court will not permit it, because the proximate cause was death, and proximate cause of the property was fire only, and claim was, and that's why they have to pay the claim, right? The owner of this building claimed the loss under the fire policy, because due to fire, na, wall of the building was left in a dangerous state. Fire occurred. That's why wall, disbalance or dislocate its shape. Due to that reason, when they demolished it, the adjoining building, collapsed. In that case, insurance company will compensate for the entire. Then we have a principle of contribution. What is that contribution? Contribution may be defined. This is second last principle. Principle of contribution means contribution may be defined as the right of an insurer who has paid a loss under a policy to recover a proportionate amount from other insurers who are liable for the loss, right? What does it mean? Contribution may be defined as a right of the insurer who has paid the loss under the policy to the insured person. I will elaborate this concept with the help of, there are certain concepts like double insurance, reinsurance. Uh, in both the cases, we will discuss the contribution. Okay. Otherwise, here I will discuss in brief, an insured may affect two or more insurance on the same subject matter of the insured. If the event of loss occurred, he recover under each of the policy up to the total loss amount. Suppose I have two policies. I'm insured person. I have two policies. One from X company of rupees 60,000, from another company 40,000. Loss from Y company 40,000. I have big loss occurred. Okay, in that case, I can recover. So big loss means, because this is very vague term, loss occurred of rupees 80,000. Now I can only recover 80,000 from both the companies in totality. 80,000 I have to, a company will divide 80,000 in the proportion of what? 6 is to 4, or we can say 3 is to 2. 3 is to 2. 80,000 into 3 by 5, the amount recovered from X company. 80,000 into 2 by 5, amount recovered from Y company. Contributory, both of the companies contribute, but I can't get the total amount from both the companies, 60,000 from X company and 40,000 from Y company. We can get maximum amount up to the policy's total amount, but actual loss 80,000. Then we have principle of mitigation of loss. What is mitigation of loss? Um, in the event of some incidents or incident to the insured property, the insured must act as to uninsured. If suppose loss occurred, you behave like a person, you don't have any insurance, and make every effort to reduce the loss, to preserve the property. He or she must take such steps to this end as he consider wise, is the rational person, and must do everything to reduce the loss. This is actually known as mitigation of loss. Understand? All these efforts made by the insured come under the principle of mitigation of loss. It means you have to, when loss will occur, you try to reduce the loss. If fire occurred, you try to call the fire brigade, and you use your cylinder, sand, every effort, so that the amount of loss diminishes. Okay, you behave like a person, you don't have any insurance policy. This is all about mitigation of loss. Now we have few important terms which are important for 3 or 4 marks questions. Sometime this particular topic came in examination for 10 marks or 12 marks. Otherwise, for 4 marks, important. Very important term, that is double insurance. What is double insurance? When a person takes an insurance policy on the same subject matter, same building, for example, building for the same building from two companies, from company A, from company B. But in the life insurance is an exception, because in case of life insurance, you can take n number of policies for your son or for your daughter or for your wife or yourself. But in case of fire insurance, marine insurance, etc., if you go for the two insurance policies for the same subject matter, if loss occurred, company will pay you only up to the amount of the total loss from both the companies at proportionate basis. The insured, by insuring with more than one insurer, cannot claim more than the value of the subject matter. Either you have three insurance companies with you, and you have three policies for the same subject matter, but proportionately different companies pay you only up to the total loss. Understand? Then we have the next point, that is over insurance. And please remind it, double insurance. In double insurance, you have to mention one example also. Then we have over insurance. Over insurance means when assured take a policy for a sum greater than the real value of the property. Say the value of the property belongs to Mr. A is rupees 10 lakh, and insured insured his policy, his house or his property with rupees 20 lakh. Okay, this is all about over insurance. But problem of over insurance do not come into the picture, because a company will pay you only up to the loss, not more than that. There is no advantage of over insurance policy. The value of my property is only 5 lakh, and or the value of property is only 10 lakh, and I go for 20 lakh policy. In that case, company will not pay me more than that amount, which is the actual value